people qualified member.
Sorry, chairman's connection disconnected, I think. Give me a minute. Sorry, members, 1 minute. Chairman is connecting. I think there is some technical problem from chairman's or system side. Now, it's okay. I will continue with the overview and welcome address. Sir, today's topic is very important. Income approach valuation. So we have got the best faculty for this topic today. Gopal Krishna sir, whose name is synonymous with this valuation and insolvency, whatnot, visa for DISA, all this terminology. Now I request Saran Kumar Uppalapati to give brief introduction of the sir.
Yeah. Is my voice audible, Secretary, sir?
Audible.
Yes. First of all, let me welcome my good friend Gopal Krishna sir. Good evening. Happy to see you after a long time.
Yeah. Pleasure is mine.
Yeah. Let me take the privilege to welcome CA Dr. Gopal Krishna Raju. CA Dr. Gopal Krishna Raju is a practicing chartered accountant, registered insolvency professional, and registered valuer from Chennai. GKR is the tax assurance and restructuring partner of Mrs. K. Gopal Rao and Co. Chartered accountants. GKR hails from a family of chartered accountants in father, mother, young brother, and wife. All are practicing chartered accountant. GKR served consecutive 3 terms of 9 years from 2010 to 2019 as Southern India Regional Council member of Institute of Chartered Accountants of India. Award honorary doctorate in governance of GST in government sector by Saint Mother Teresa University, Melbourne, Australia. GKR is in the independent directors bank data bank and have qualified the online proficiency self-assessment test conducted by Indian Institute of Corporate Affairs under the aegis of Ministry of Corporate Affairs with distinction. Other qualification, just to list n number of qualification I can see whenever I get the visiting card of GKR, just to put a sum before you, is a qualified valuation examination of Insolvency and Bankruptcy Board of India, qualified limited insolvency examination of Insolvency and Bankruptcy Board of India, associate member of the Institute of Cost Accountants of India with all India rank in the intermediate examination, associate member of the Institute of Company Secretaries of India, the twin postgraduate diploma holder in Operation Research and Financial Management from Pondicherry University, MPhil in Management from Tamil Nadu Open University, qualified information system auditor, and so on. He authorized top 1 standard costing and variance analysis for professional students. The second one, first lessons in information technology for CAs with the 2 editions by Snow White Publishers, Mumbai. GKR is a seasoned speaker on information technology, finance and taxation, and visiting our guest faculty for numerous institutions or corporates and B schools. GKR is the member of Institution of Directors, Bombay Chartered Accountants Society, and Madras Management Association, and life member of the Society of Auditors, the Chartered Accountant Study Circle, and rotation. He is a versatile speaker. GKR has addressed more than 500 meetings on GST to various forums, including professional bodies, Chamber of Commerce, industry and trade associations in both English and Tamil. Sir, it looks like, reading a bare act, looking into your profile. Okay, I myself just closed the preamble with this very brief introduction of GKR. I am just introducing before you all. Sir, over to you, Secretary, sir.
Yeah, like I told, welcome back, Deepak Ladda, sir. Please speak few words before the speaker starts the session.
Thank you, Secretary sir, for giving the opportunity once again. And I'm extremely, I apologize for the technical glitches. And unfortunately, I was the disconnection went off, and I was forced to log out. I have logged in. Sorry, Gopal Krishna Raju sir, I could join late. But given an opportunity, I would not like to miss add few words. As Sharan Kumar sir has already introduced the speaker in a very systematic way. As we all know, is GKR is a few person who are the multi-talented. You take any subject, whether it is valuation, whether it is Companies Act, whether it is GST, whether it is direct tax, sir is some which the versatile, and he can talk on any subject or with a lucid presentation and excellent comment on the subject. And sir, we are very thankful for you from on behalf of Managing Committee of Hyderabad Branch and on behalf of Hyderabad Branch members for kindly consenting to talk to on such an important topic despite your busy schedule. I'm sure every alternate day you will be talking from across the country. Very thankful for you, sir. And as you already at 6:10, I would not like to waste much of your time and hand over the session directly to the speaker. Over to you, sir. Thank you.
Okay. Thank you. The chairman of Hyderabad branch of SARs of ICI, CA Deepak Ladda ji, Secretary CA Ravi Shankar Reddy Garu, and the chairman of SICASA of Hyderabad branch, young and dynamic Excel expert, CA K. Saran Kumar, and all the members who are virtually connected from the Hyderabad branch and also the other parts of the southern region. A very warm good evening to one and all. At the outset, let me thank Hyderabad branch of SARC of ICI for this wonderful opportunity today for a topic on valuation under income approach. Now, before I take into this topic, let me give a brief prelude about this topic and its relevance in our current day-to-day practice, especially the younger generation, the newly qualified chartered accountants. They wish to actually establish themselves in new area of practice. And the president of Institute of Chartered Accountants in a recent, when he addressed, he made a point, very important point actually, that in addition to the traditional practice, the emerging areas of practice like valuation, insolvency has to be taken up by our members across the country, and especially requesting the younger members to be very keen on these emerging areas. Coming to topic today, the relevance of this topic is not only maybe for a CP program like this, but also for various subjects, starting from Income Tax Act, Foreign Exchange Management Act, mergers and acquisition. With respect to maybe when you say merger, demerger is also we need to consider. And with respect to insolvency and bankruptcy code, where for a resolution of insolvency, a company, a corporate which has been pushed to an insolvency state, they have to actually come back to the normalcy, for which also evaluation is required. And there are various regulations where Security and Exchange Board of India also has mandated valuation. Apart from a mandate prescribed under these laws, there are certain places where there is no mandate, but there is a requirement for valuation, especially if we can take the buyback of shares. there is no prescribed methodology. I repeat, there is no prescribed methodology, but the section very clearly mentions that there should be a basis for arriving at the price for buyback. And buyback is mentioned in section 68, 69, and 70 of the Companies Act. We can also take Indian Accounting Standard 102, share-based payment, especially with respect to the employee stock options. Whenever the stock options are discussed, say a 10 rupee share, maybe market price is actually 400, but it will be offered at a price somewhere in between this 10 and 400, maybe 120, 200, 220. Now, how do we arrive at? Indian Accounting Standard doesn't prescribe any person who has to do the valuation, but they prescribe a method. They prescribe a methodology, and that methodology is income approach. So here and there, we can see in the crowd somewhere a light, like a yellow light, somewhere in the crowd, and these lights are not dull lights, these are bright lights, and you can easily spot this. Now come to today's topic, and I wish to be a practical session, but I need to first make a presentation with respect to what an income approach and what are all the various methods available under an income approach, the factors under income approach. Then maybe if time permits, wish to do case studies and various case studies. And maybe if we will also have a Q&A at the end. I'll try to give my presentation for maybe 1 hour to maximum 1 hour 15 minutes or 1 hour 20 minutes max. And then I'll invite queries from our professional friends. So let me now share the screen here. Good. So before I venture into this topic, I wish to make one very important point to all of you, that I will be referring to two standards. So one is IVS 105, that is International Valuation Standard 105, and ICA Valuation Standards, which is 103. So this 103 and 105 is the standard I will be referring to. And whenever we say valuation, let me take an example. And we have already done this in our CA final also. It will be with respect to valuation of a business, valuation of a firm. So where the future cash flows are discounted. The future cash flows are discounted using a discount rate, and we arrive at the present value. And that present value, it will be the worth of the company. So this is in a very simple terms. Now, as a valuer, as a registered valuer or a chartered accountant doing a valuation, it can be, for example, you are doing a valuation with respect to a buyback. There is no prescription that you need to only be a registered valuer to do the valuation. But there is a necessity to have a basis to arrive at the price. And therefore, it is always suggested to go for a evaluation report by a professional and a seasoned professional with amount of experience, a good amount of experience in valuation. Good. Now, even though this evaluation approach, they discuss about three methods. One is, so they discuss about three methods. That is market approach, income approach, and cost approach. Market approach alone, we require another 2 or 3 more hours. Cost approach, we may require another 2 hours. And there are very many places where cost approach is still used. For your information, Income Tax Act. Under Income Tax Act, the fair market value, that fair market value concept is a Kichdi concept, where it considers both the cost approach and the market approach. It is a Kichdi of both cost and market. So maybe we need to explore and symmetrically and diametrically, we need to explore the Rule 11 UA onwards with respect to valuation. These two approaches are given there in a different avatar. So therefore, our focus will be with respect to income approach. Now, as I told you, I'll be referring to both these standards, 103 as well as 105. I have also taken both the standards here. Okay. So I will only show the PowerPoint, and wherever required, I'll show the directly the respective standard itself. So this is our ICA valuation standards, and this is our international valuation standards. And in international valuation standards, I'll take you to 105. And under 105, I'll take you to this income approach, which is in section 40 as well as section 50. So this is your section 40 income approach, as well as section 50 will be income approach methods. So now I'm taking you to what is income approach. That is the first aspect we are going to understand. What is meant by an income approach? And here I'll take you to para number. This is section 40. The section 40 has a few paragraphs, especially 5 paragraphs are there. In that para number 1 speaks about what is income approach. And you will be surprised, the same information is discussed in our ICA valuation standards 103 also. So let me take you to 103, and this is our 103. This is 101. I'll take you to 103. This is 10. And 103, I'll take you to para 49. And para 49 as well as para number 40.1, both they only mention the same. This is para 49 and this is 40.1. This is an international valuation standard. What is income approach? In short, please look at this. It is a value determined by converting the future cash flows to a single current value. That's all. So that means future cash flows to a single value. So maybe you may have for 5 years, 7 years, 10 years, and they don't use a word called infinite. Infinite is not a correct word to use in valuation. There is nothing called infinite. If we don't know a number, we call it as indefinite only. So there is no infinite concept as such. So very interesting terminologies are there, and maybe when we appreciate it, the practical side, the practical sense of it, we'll actually in a position to take this in a. Now, please look at this. The income approach, it says the converting the future cash flows into a single value. Now, how do you convert it? Using a discount rate. So now what your para 49 says, look at para 49. Here also it says converting future amount to a single amount. Now, how do you do it is the next point. So let me now take you to the next one, which is para number 50.1. Okay, 50.1. And I want to make one observation, comparison with respect to the methods which are prescribed in para 53. Look at para 53. Here, what are all the various methods under income approach? So let me take you to international valuation standards para 50.1, where they say, although there are many ways to implement income approach, but international valuation standard, they don't mention these methods for your kind information. They don't mention. But I will come back to these methods which is discussed in our ICA valuation standards also. There are variations of DCF. Please look at this. So that means DCF is the fundamental method. Discounted cash flow is the fundamental method. And the concepts apply in part or in full to all income approach methods, to all. Now, which are those all methods has not been mentioned in this paragraph or in this standard. But I want to make one observation that in various other places they are discussing the other income approach methods, especially in the other standards. In the other standards, they discuss. In the other international valuation standards, they discuss. But look at our ICA standard. Some of the most common valuation method of income approach, one is DCF method. RFR, MEEM, meme method, with and without method, option pricing model, like Black-Scholes Merton model and binomial model. Okay. Now, let me take you to this paragraph at the end. You will be quite surprised, especially I'll take you to para number 94. Okay, I want to take you to para number 94, which totally will take you to, look at this. This is para number 94. The multi-period excess earning method, which is mentioned there. Okay. The relief from royalty method, okay, with and without method are used only for valuation of intangible assets. Even though it is given here, you have a separate standard for intangible assets. Please look at this. You have a separate standard for intangible assets. 302 intangible asset, 210 in IVS. You have a separate standard. So there it is discussed. So therefore, we need not, I will not in this limited time, because to discuss one method of evaluation of intangible asset, mean multi-period excess earning method, okay, especially example of valuation of the customer oriented intangible asset, okay, customer based intangible asset, okay. So that we will go by multi-period excess earning method. So that alone, we need at least an hour and two to discuss about that with the case study. Okay. Then relief from royalty method. That is also an intangible asset valuation method. But remember, all these three methods are income approach only. So they have mentioned very clearly that it is used only in intangible assets. So not much discussion is given in this standard, but it is discussed in the intangible asset standard. And option pricing model. Now, for your information, this is your this is India AS 102. This is your India AS 102, and let me take you to option pricing model. Look at this option pricing model, especially para number 47 A1. Look at please 47 A1. The option pricing model and the inputs that are used. These are the 6 factors. These are the 6 factors which will be used for the option pricing model. What is it? The spot price, the exercise price, volatility, then the time factor, that is N, and the dividend in between the spot price and the exercise date, spot date and exercise date, and the interest, risk-free interest rate. So 6 factors. And these are discussed even in our these are also discussed in our, so let me take you to, so option, this is also discussed. Please look at this. This is also discussed in para 92. The same 6 inputs. So the important inputs required for these models, for your information, but not discussed. So they only give inputs and they say, so you have specific guidance on the aforesaid valuation methods provided in other relevant valuation standards. Especially, you have financial instruments. You have a standard for financial instruments, which is 303. So your your standard 303 as well as standard 500, they discuss in greater detail with respect to the option pricing valuation model and also the other models also. Okay, so there. So meme relief from royalty with and without method are discussed in intangible asset standard, and your option pricing model standards are discussed in other standards, which is actually financial instruments 303 or here 500 international valuation standards. Very good. So that is one reason why you will see in international valuation standards, especially in para number 50.1, they are not touching any of this. Why? Because in the respective standard, they are discussing option pricing, especially in intangible asset 210, they are discussing about the meme method, relief from royalty method, as well as the with and without method. Okay. Maybe if kindly note down this, if any of the participant, they wish to have any inputs on this, please note down, and during the interaction, maybe I'll throw more light on that. Good. So as far as this standard is concerned, they only discuss about DCF only, but the other methods are also income methods. Okay, for your kind information, the other methods, the 5 methods they are discussing. Okay, in our ICA valuation standards, they are discussing the 5 methods, especially given in para number 53. So let me take you to 53 here. This is your 53. Yes, these are the 5 methods discussed. Now, let me now take you to DCF method. Okay, good. So what is DCF method? 54. This is para 54, and the equivalent paragraph here is 50.2 as well as 50.3. This is what they discuss about DCF. And already in the starting point itself, we have understood the future cash flows discounted using the discount rate. Now, you have question mark here. What is the cash flow? Number one, when you say future, how long? Okay, how long? So there is a terminology called explicit, I repeat the word, explicit forecast period, because you have to forecast. So there is a term called explicit forecast period. So till that explicit forecast period, meaning, what is an explicit forecast period? Will it be 5 years? Will it be 7 years? Now, I want to make one observation here, especially what our ICA valuation standards they prescribe. Okay, I want to bring your kind attention to para number 62. So please go to para number 62, where it says, in most cases, the projection shall comprise of profit and loss account, balance sheet, cash flow, along with certain assumptions. However, the balance sheet are not available. So that is not the only criteria for arriving at your future cash flows. The future capex, working capital requirement may also suffice. So that is with respect to your maybe investment. But with respect to revenue, you need some data. Okay. So wait, how that data we will actually project? What is the basis? What are the factors we need to consider? And in our valuation report, all these have to be mentioned. Okay, that is the catch here. Now, let me now go to 50.3. In some circumstances, the long-lived or indefinite lived assets. Okay, so please look at these wordings. I was referring to that they will never use a word called infinite. So infinite is not a right terminology in valuation, because there is nothing called infinite. It is. It depends upon. Maybe if our chairman takes a Viswarupa avataram, okay, Viswarupam, okay, then he can even see, sitting at Hyderabad, he can even see Bombay, he can even see Delhi. So now somebody asked me, which is very closer? Is Delhi is closer or sun is closer? So the other guy, she said, no, sun is closer, because I can see sun, but I cannot see Delhi. Only if you take a Viswarupa avataram, then you can see. So the moment you take Viswarupam, then what is infinite for me? Okay, for the Viswarupam, it will be finite. So therefore, the concept of infinite and finite is relative. Is related to whom? Okay, is relative to who is actually mentioning that. So that is why in standard they are very, very clear. They only use a word called indefinite. Okay. So in some circumstances, for long-lived or indefinite-lived assets, okay, DCF may include a terminal value which represents the value of. So the terminal value means you are only able to explicitly forecast. Explicit means in return, committed. I am able to only see 3 years. See, generally it is like this. A running train, when it is up, when a station is approaching, okay, it will not go in the same speed to station and then it will not stop there. So at least 2 or 3 kilometers, 5 kilometers before itself, the acceleration will be reduced. That they will not give acceleration. So the momentum, the train with the tons of steel, okay, so it is coming at a momentum. That momentum, you don't accelerate that same momentum. Okay, so that is what we say. Mahendra Singh Dhoni is in form. Sachin Tendulkar is in form. In the same form, he has to go to the World Cup, hit the sixer, and then get the World Cup. That form. So, how long that form will be there? So, Sachin Tendulkar, will it be in? He be in the same form for how many years? Mahendra Singh Dhoni will be in the same form for how many years? That is where you have the catch. Okay, the explicit forecast period. So to be in the firm, it is not that easy. You need to practice, you need to keep your diet, you need to keep yourself healthy. Muscle should be toned. So you should practice a lot. So a lot of stuff is there. So same is the case. Okay. So DCF may include a terminal value which represents the value of the asset at the end of the explicit projection period. Now, I want to make one very interesting observation here. Now, what is this explicit forecast period? Now, please come to para number 54. Okay, this is what the ICA valuation standards, they say. DCF method values the asset by discounting the cash flows generated for the explicit forecast period. Not only you are discounting for the explicit forecast period, meaning 5 years is the explicit. So you define 5 years only I can project. 5 years only I will be in the farm. Beyond that, I will be in the farm. I'm presuming I will be in the farm. How long? Indefinite. It is not infinite. It is indefinite. So any business, only God is infinite. Okay. Only God, because God is, we have not seen. So you can always say, so in BC also God was there, in AD also God will be there, and in another 100 years, 1000 years later also God will be there. So that for God only we can use the word called infinite. But for all man created, humanly created, maybe if we are not able to project it, we are not able to explicitly calculate, we can only use the word called indefinite. So that is why beyond the explicit period, whatever cash flows are there, we'll calculate a terminal value. So calculate all the cash flows beyond the explicit period using a model. That model, we call it as terminal value. And for terminal value, we have 4 models. And you must take the terminal value, the Gordon model. So we have the P0 equal to D1 divided by KE minus growth rate. So that formula, so if it is a terminal value is the 5th year end, so T5 you will take. T5 is equal to P6. The term P6, P5 is equal to D6. Okay, what is the formula? P0 equal to D1 divided by KE minus growth rate. Now for 5th year terminal value, so we call it as P5. So P5 is equal to D6. Instead of D1, it will be D6. Instead of P0, it will be P5. So P5 will be equal to D6 divided by KE minus growth rate. Wow. So that perpetuity value, otherwise called terminal value, in case of assets with the indefinite life. They don't use a word called infinite. And for your kind information, this is the term even your Indian accounting standard also will use. I want to make only one observation, especially India is 38. Okay, this India is 38 is a place where they speak about indefinite. Okay, indefinite as well as infinite. This is one para where you will see the difference between indefinite and infinite. The term indefinite does not mean infinite. This is the place where it is given. It is in Ind AS 38, para number 91. The useful life of the intangible asset reflects only the level of the future maintainable. At that time, estimating useful life. A conclusion that the useful life is indefinite should not depend on the planned future. So just because you are not able to project it, you have to say indefinite. So intangible asset, what is the life intangible? So it indefinite. The moment it is indefinite, so what will you do? Can you depreciate it? You cannot depreciate. That means you cannot amortize. The moment it becomes from indefinite to definite only, you can amortize. So that is why this standard is very, very significant. Okay. So the moment intangible asset will go from your this particular intangible asset doesn't have any life. Maybe you'll have only 2 years or 3 years or 5 years. So then you amortize it. No, intangible. I am the king, monopoly. Nobody has this formula. Nobody has this. Okay. So then you are the king. So you only have the Covaxin. Nobody is having the vaccine against COVID. Then that license will be an indefinite value. Okay. The moment you have an alternative, Govinda. Okay. The indefinite will become definite. Actually, we have to only say indefinite. The opposite. What is the opposite of finite as far as accounting standard is concerned or valuation standard is concerned? The opposite of finite is indefinite. Okay. Not opposite of finite is infinite. Interesting. Now, that is what it is. So in other circumstances, the value of an asset may be calculated solely using a terminal value. Good. So now, what is terminal value? We just now discussed about this. I'll take you to para number 50.23. Okay. Para number 50.23 will speak about, sorry, I'm here. No. Okay, I'm here. So this is para number 50. Yes. Terminal value. This is our terminal. Now here I am taking you to the various methods. This is the various methods. Yes, 22. Okay, please look at this. So there are 3 most commonly methods used for calculating a terminal value. So one is Gordon model. It is only constant model. But here I want to compare with the ICA valuation standards, where they are actually I will say a little more practical. So sorry for this. This is here. So what I will do, I will go for terminal value. Okay. So terminal value. So you have terminal value definition is also there. Terminal value. So that is in para number 76. Look at 76, guys. Look at 76. There are different methods for estimating terminal value. The commonly used methods are Gordon growth model, constant model actually. So this is Gordon constant model. After that, it goes to exit multiple. So market approach or exit multiple. So at the end, what is the market value? Especially in intangible asset also we will have. So after using the intangible asset for 3 years or 5 years, you have a concrete agreement, standard agreement with the buyer that he will take that intangible asset at an agreed price and it is signed. So then you have a exit value. Sorry, you have an exit value. So appropriate for finite lived assets. Okay. Gordon model appropriate for indefinite lived. So indefinite lived means right from year 1 to indefinite period, it is constant growth. 5%, 6%, 7%, 2%, 3%, some growth is there. Now, this growth rate, how do you find? Discount rate, how do you find? Next time coming for that. Okay. Then the third is salvage value or disposable value. So maybe if you don't have a market value, then we'll go for a salvage value for that asset. Okay. Or for that business. Okay. Whatever. Appropriate only for deteriorating. But here in ICA valuation standards, I want to bring to your kind attention about one more model. This is the 2-stage growth model, 3-stage growth model, 4-stage growth model, N-stage growth model. See, look at this. That means maybe the first 2 or 3 years 10% growth rate. After that, another 3 or 4 years, 12% growth rate. Then the third, what do you call it as the third phase, 3-stage growth. Third stage will be a constant growth. Then for the constant growth, you will apply the model 1, and for variable growth, the stage 1 and stage 2, phase 1 and phase 2, you will calculate. That will be your explicit forecast period. So you have to calculate and then you have to discount it. Okay. So this is very interesting aspect. Good. Now, then let me take you to the aspect called as the key steps in DCF method. Especially, I'll take you to para number 57. Please look at para number 57. What are the steps in deriving a DCF? Now, very similar paragraph is there in para number 50.4 of International Valuation Standards. So, International Valuation Standards in para 50.4, the key steps in DCF are given. And here they give in 57 for your information. Saying, look at C, choose the most appropriate type of cash flows. Here also it is given. The appropriate type of cash flows in 50.4 for your information, it is in A. What is the appropriate type of cash flow? It is in A. Right. Then the explicit forecast period, it is given in D. So find the explicit forecast period. So here the explicit forecast period is also given. That is given in B. Okay, now I want to bring your kind attention to one very important point. The moment you say type of cash flows, okay, look at this type of cash flows. This is one place I want to bring your kind attention, because they use the word called VIZ. That means example. Okay, example. Here also they say that is pre-tax cash flow, post-tax cash flow. Free cash flow to equity, FCFE and FCFM. They stop with this. And of course, even though it is only illustrative, one more illustration is given in International Valuation Standards for your kind information. They say nominal cash flows and real cash flows. Okay. So even though here also etc. is there. So here there's one more angle at which the standard explains the cash flow is with respect to real cash flow and nominal cash flow, and that is also discussed in para number 50.5, the cash flows, real cash flows as a nominal cash. This is not discussed at all in ICA valuation standards. So that is why whenever we want to apply the standards, let us actually take the best practices of both the standards and we'll implement that in our valuation report for your information, please. Okay, good. So that is where these are the factors we need to consider. So everything is there. So type of cash flows, explicit period, and you need to know the appropriate discount. Now, what is discount rate? That is the next question. Okay, very important discussion is discount rate. Okay, I need more time here, and I'll apply the discount rate to arrive at a single value. Okay, now let me take you to discount rate. So here I will take you to para number 72. So this is valuer may consider the following factors while determining the discount rate. And for your information, para 69 says what is discount rate, and I will also take you to para number the 50.30. Okay, so 50 points. So maybe I'll even keep it here itself. So 50.30. Yes. So the rate at which the forecast cash flow is discounted should reflect not only the time value of money, but also the risk associated with the type of cash flows in the future are very important. So that is why, how do you actually arrange? That means you have to use the risk factors also in your, so that means your discount rate considers the risk factors. Your cash flows also should have, when you have the higher discount rate, higher risk, your cash flows also will be more because you take more risk. So this is very important. So what is the business risk? What is your operational risk? Okay. So what is your interest risk? All this matters to arrive at your discount rate. That is why I wish to share with you one very important paragraph. Okay. a very important paragraph with respect to the discount rate. So look at para number 50.3231 also. The discount rate are developed. There are many methods for developing a discount rate. It is not discount rate, it is calculated. So discount rate is not calculated. Now, when you interview, there was a guy who interviewed Meman Mapillai. Meman Mapillai was he was the current, what is it, the MRF tires. So for MRF tires, he is the chairman and managing director, Sri Meman Mapillai. So there was one question that was asked. Okay, how do you manufacture tires? Can you please explain in simple terms, because you have been a leader in manufacturing tires. So for that, Mr. Meman Mapillai said the question itself is wrong. We don't manufacture tires, we build tires. We build. So like how you construct a building, we construct a tire. So tires are not manufactured, tires are built. Very important distinction. Now, please look at para 50.31. Discount rate is not calculated. Discount rate is built. Discount rate is developed. Very, very important point. Okay. So that means there is a very nice dialogue in Hindi. Okay. Main chun chun ke marunga. Okay. I will select one by one and then I'll kill you. Okay. So discount rate, you have to take from here, from here, from here. Then you have to assemble it. Then only you will get the discount rate. So discount rate is not a calculated figure. It is actually a developed number. It's a rate that is developed. So I want to bring to your kind attention these two paragraphs. Very important paragraphs, guys. And I'll also bring to your kind attention para number 72. Okay, 70, 71, I want to bring to your kind attention of the ICA valuation standards. The following discount rates are most commonly used. It is actually a very generic statement. Now, which I have to use? Okay, cost of equity, KE, weighted average cost of cap. These are theoretical. You ask any student who is doing maybe capital budgeting, he may give. And we also know the formulas for all this. So it is not the formula that matters for your information. That is why different methods are used for determining the discount rate. This word is very important. Okay. So what the word that is used, you have to develop a discount rate or determine the reasonableness of a discount rate. See, nowhere they use a word called calculate. Okay. Use a formula. This formula only you have to use. No, they don't say. Standard doesn't say this. And that is why today we have an issue. In Schedule 3, the recent Schedule 3, there is a requirement to give ratios. Now, in that ratios, the ratio alone is given. Debt equity ratio is given. Now, what is debt to what is equity? Now, debt by equity is also debt equity ratio. Debt divided by debt plus equity is also debt equity ratio. Both are same. Actually, numeric wise, both are not same. But debt equity ratio, I can interpret in both these ways. So that is why Schedule 3 makes it very clear that you give this ratio and also define the ratio, explain this, what is the formula you have used, what is the numerator, what is the denominator, you have to explain. That is why, please look at these wordings. Valuer may use any reasonable method for developing an appropriate discount rate. Okay. While there are many methods for developing a discount rate or determining the reasonable, a non-exhaustive list is given below. So you develop. That's all. Built-up method, weighted average, WACC, CAPM, or observed yield. That is yield method. And for your kind information, ICAI also says you look at yield. Weighted average cost of equity. Same is given here. Okay. But look at this 30.3 to 50.3 to 32. Very important. Valuer should consider corroborative analysis. This is not given for these four So therefore, they have given 7 approaches. Here they have given actually 3 approaches only. Either you go by CAPM model. What is CAPM model? RF plus beta into RM minus RF. So risk-free rate plus beta into RM minus R. Now risk-free rate you have to tune. Therefore, you have to find out where it is. You need to do some analysis. Okay. So determine. Then you need to calculate beta, which is a regression coefficient of your values. Okay, your asset value with respect to market. So what is market? You need to actually find out, and that market, how it is sensitive, and when market changes, how your company is sensitive to that market. So all these you need to actually collect some data and find that beta, or you can take a reference rate. You can take a reference rate. For that, lot of say for example, I want to give you some maybe very interesting. I'll say some websites I'll give. Okay, especially I'll give the websites of Damodar. Okay, so Damodaran. Okay, Damodaran ERP reference. So please look at this. So this is what is your ERP reference. That is equity risk premium. Okay, that is RM minus RF. So RM minus. So if you know RF, then you can arrive at the market rate. So this is actually downloaded data. So straight away I'm giving you. Not only this, there are so many reference sites like this, which has okay. So this is your updated values. So sorry for that. I will take you to the home page itself, where you have the equity risk premiums. Okay, this is your equity risk premiums. So you have a lot of equity risk premiums downloads are there. You can download it. Okay, so it's available here. It's here. Look at this. So 1962 current. My good. This is actually Excel data. So much of data are there. So look at this. My God. So chart 1, chart 2, chart 3, that this. So all these data are there. You can go and take. So this is actually reference rate for your kind information. Okay. So valuer should consider corroborative analysis in assessing the appropriateness of a discount rate. So you want to take a IRR, VARA is there. Now please understand what is VARA, weighted average return on assets. Now weighted average cost of capital is liability side. You have cost of equity, you have cost of debt, then you apply the weights of the equity and debt, so you arrive at a weighted average cost. Now what is VARA? Now this is actually you have to reconcile. Now liability, you have weighted average cost of capital. Naturally, you should also have the return on assets also. So the return on assets is what? Return on assets on your working capital, on your fixed assets, on your intangible assets, on your maybe current assets. So you arrive at the percentage. Now these are very important, especially when you do the intangible asset calculation, which we call it as CAC. So CAC is your the contributory asset charge. So VARA is the weighted average return on all the assets. The individual asset is what they contribute. Contributory asset charge, the individual rate. Maybe VARA, if it is say weighted average cost of capital is 18, VARA is 18. That 18 will consist of rate contributed by 7% by fixed assets. Then investment will contribute maybe another 6%. So 7 plus 6, 13. Current asset will contribute maybe another 7% or 8%. So like that. So that is VARA. So that now that is very useful. And again, you need to have a breakup of that. So this is what the corroborative analysis has to be given, and the corroboration has to be done only for these 3 methods. Maybe IRR, VARA, and maybe any other approach. What they say, value indication from other approaches other than these 6 methods. Now, what is a built-up method? One by one. So that is actually what your Mr. Maman Maple said about tires. So let me now take you to that particular part. So please look at this part where I'll take you to I'll take you to this is one. Look at this. These are all the various methods given: CAPM, WAC, observed, IRR, VARA, built-up method. Now, what is built-up method is this? How do you build a discount rate? Now, I'll now take you to that particular aspect. What do you call it as the risk adjustments. Okay, so risk adjustment is the next point I will take you through. Now, this is how you arrive at a discount rate using built-up method. So you start with the risk-free rate. You don't start with 0%. You start with the minimum rate what is required. Okay, so 5 risk-free rate. Then you go for the ERP. Equity risk premium is your. I gave you that. This is your Damodaran's historical premiums. ERP from 1960s you have with respect to earnings yield, dividend yield, with respect to sector-wise. Automobile sector, textile, everything. Not only Damodaran has, so many other sites are there. For example, you can even go, where is the risk-free rate I will get? You can go to FBIL. Okay. So, Financial Benchmark India Limited. So, here you will have the risk-free rate. So, this is your, you will have the money market interest rate, then fixed income securities rate, derivatives. So, this is actually a FIMDA, if you will know more about this. So look at about us. This is actually a benchmark and indices value. FBIL is jointly owned by FIMDA, FEDA and Indian Bank Association. So this is an authenticated site. So it is not the no, why should I go only for Damodaran site? That is only authenticated. So not necessary. You can go on for a Desi site also. And they also, and a lot of research institutions are there. A lot of intermediaries, financial intermediary sites are there, various AMC companies are there, and credit trading companies are also there. They also put a lot of market data. Okay, these are the guys, they have market data. So they will not give the current data, but they will give the at least 1 year old data they will give. And maybe you don't know what is current data, means maybe you can do a projection. Okay, you can do extrapolation. And in extrapolation, then you have a lot of market information. Put that. And market information, you can do the adjustments. You can do adjustment. Remember, guys, doing adjustment is a sin in accounting. But not doing an adjustment in valuation is a sin. Because that is what? Because when you have the historical inputs, how do you actually arrive at your current? You need to do an adjustment. So that is the thing. Now, I want to make one more interesting observation. Okay. See, discount rate, will it be constant? First year, 14%. Second year, 14%. Third year, 14%. Fifth year, 14%. Sixth year, 17%. All 14%. Not necessary. So, your beta can change. And when beta can change? Your capital structure can change. If your capital structure changes, for example, you had a 70-30 capital structure, then you increase the capital structure, the debt increases. So maybe if your debt increases, your beta will change. Your beta changes as per your Capm model, your required return. So risk-free rate plus beta into RM minus RF, discount rate changes. So year after year, discount rate will be different. So therefore, no. Or CA final and the CMA and the CA intermediate and all, we only use one discount rate for the entire question. How can that be multiple? That is to give you an understanding how you have to future cash flow you will discount. But practically, that practical scenario, not necessary that your risk adjustments. I want to take you to para number 40.4 and 40.5. Look at para number 40.4 and 40.5. It's a very important paragraph. Okay. Now, what is 40.4? The fundamental basis. So, fundamental basis for the income approach, the investor expect to receive a return, and that return should reflect the perceived level of risk in the investments. So, as higher the risk in the third year, fourth year, income will be more. Income will be more. Wow. Your valuation will be more. No. The discount rate also will be more. No, same discount rate for first year, second year, I will do for third year. No. What they say, look at para 40.5. Generally, investors can only expect to be compensated for systematic risk. So that means also no market risk or undiversifiable risk. So wherever you go, not a diversifiable risk, your company, internal risk. Internal risk will be padded in your cash flows itself. But external risk, okay, that you have to only consider with respect to your cash flows or in your discount rate. So that is what we're saying. So investors can only expect to be compensated for systematic risk. So maybe through your appropriately calculating your. So therefore, this discount rate calculation is a very sensitive area, especially in valuation, very sensitive. And for your information, the gap between KE minus growth rate, that is whenever you calculate the terminal value, I just want to share with you maybe many case studies I want to actually do, maybe with I don't know how many minutes I'll have to actually do this, but I'll just share with you as many illustrations as possible. Say for example, this is P0 equal to, the formula is D1 divided by KE minus growth rate. So this is your Gordon model formula. This is your denominator, that's your numerator. So your D1 is blue color is your numerator, and your red color is your denominator. Okay, so this is your P0. Now I will just make maybe if your explicit period, explicit okay, forecast period. The explicit forecast period is let me consider this as say 5 years. So that means 6th year, 7th year, 8th year, 9th year onwards. This is indefinite. After that, it is indefinite. So then you will find the terminal value. So what is terminal value? Terminal value is P5, that is equal to D6 divided by, so which is actually not D1. It is, since it is P0 equal to D1 by KE, P5 is equal to D6 divided by KE minus growth rate. So I need to find, say, let us say D6. Okay, it is 450 crores. Okay, and your KE, this is one. For example, if this is free cash flow of the firm, your this cannot be KE. This will be KO. Now, if you are saying D6 is actually free cash flow of equity, I will take this KO as KE. So this is the small adjustment. So we take the basis, but when we apply, for your information, only ICA valuation standards, para number 68, they speak about FCFF and FCFE. Okay, and international valuation standards, they don't speak about these two, for your information. So let me now show you that aspect also. So please look at para number 68. Following are the cash flow which are used for projections, FCFF as well as FCFE. Now please look at your growth rate. Let the overall cost of capital is, say, let it be 15%, and growth rate is 5%. So now what is your P5? I will use the same formula. Your D6 divided by KE 15% minus growth rate 5%. So it is, sorry for that. So it is B9. So it is 4,500. Now I will just reduce this gap. This gap is 15% and 5%. Now if I increase the gap, value will come down. For example, I put 3%. That means original 10% gap, now it is 12% gap. Valuation is coming down. Now I am reducing the gap. I'll make it 12%. Growth rate is 12%. Valuation will go fadafat damal 15,000. So as the gap rate is reduced, so now growth rate is 10% or growth rate is 7%. Look at 5,006. Now even 1% reduction in your cost of capital, valuation will jump. Now that jump, say now it is 5,625. Okay. Now instead of 15, I'll make it 14. My God, it is 6,428. So almost 800. Look at the difference. Now instead of 14, it is 13. 7,500. But look at the gap. Is it 800,000? As the gap one by one it is reducing, the valuation multiplies. Now I'll make it 12. Dumil, it is 9,000. My God. Now look at the gap. It is not even 800. It is not even 1000. It is 1500. Now look at the, I'm reducing it to 11%. Look at this. It is 11,250. So it is, that number is so sensitive. Okay. Now look at this difference. It is not 800. It is 2000. So it's almost 4 times that. Even 1% gap, the valuation multiplies. So that is why this is terminal value. So terminal value is terrific, I'm telling you. So that can change the game changer. Your LIC valuation, Paytm valuation, Zomato valuation, all these valuation, the game changer is discount rate. And using discount rate, the terminal value. Using terminal value, again discounted to arrive at your present value, that valuation. So 1% can actually change the entire contour. Okay. So that is why, if at all I am using CAPM or WAC. Now the problem with these two methods and the comfort of these three methods are different. Say built-up method, I just showed you that built-up method. So where is built-up method? This is built-up method. Now look at this built-up method. I'm here. Look at built-up method. You go step by step. So it is a risk-free rate is 2.25. Then you go by the equity risk premium. You have a basis for it. 2.25, you have a basis. Maybe you go to FBIL. Equity risk premium, you go to the related market sector specific equity risk premium. Then beta adjusted risk rate premium. So then you have the company specific risk premium. So this is called one is called the unsystematic risk, another is called the systematic risk. Now what is systematic risk, what is unsystematic risk? One is internal, one is non-diversifiable, one is diversifiable. Now I'll just again take that term what I just showed you in para number 40.4, and again I'll come. Now please look at para number 40.4. Look at 40.5. Systematic risk is market risk. So undiversifiable. So company 1 to company 2 you go, it is market only. Risk will be there. But company A will have a what is called a firm specific problem. The company B will not have the company A's problem there, but company B will have a different problem. You may leave the lab. So that is called diversifiable. What is diversifiable? Company specific. What is non-diversifiable? Market risk. Undiversifiable. Wherever you go. So once you are married, you cannot escape the risk. You have to always face it. So that is there forever. So undiversifiable. So let me actually take you to this. Where am I? Look at this. So that built up. So this is company specific risk premium. So that is diversifiable. Now what is non-diversifiable? So that is your ERP. So that I will go with the reference or the sector specific rate. So two things I have to take. Now for how I will measure this, you have to take some factors. Variability. So what is your turnover or your expenditure? You have to find out which is more sensitive to your company. Your bottom line, top line, expenditure. You have to identify. You have to do an analysis. That is, your valuation is not an arithmetic. Valuation is not an arithmetic. I just want to share with you that valuation means two things. One is estimate. Second is judgment. Valuation is two things. Valuation is not calculation. Valuation is estimation, but using your judgment. Okay, so that is where, and that is what your report should say. No, it is like an audit report. I will take audit report A, I will copy this. You give me your valuation report. I will do my valuation. No, that is not so. It is not an audit report. I know I'm addressing chartered accountants and our professional brothers and sisters only, but let us understand one thing very clear, that an audit report, we go by a statutory format. But a valuation report, there is no format. There is no format. Till date, there is no format. Why there is no format? Why there is no format? There is no requirement for a format, because the experience of the valuer has to be reflected in the report. That is why as the valuer matures, as the valuer has more gray hair, okay, black hair only I have, but as the valuer has more gray hair, okay, then his report will be more mature. His report will look more practical. Okay, so he will actually the basis of arriving at the valuation will be more scientific. Okay, so that is most. So he is not doing a calculation. He is determining. He is determining a value. He is arriving at a value. So that is why this discount rate is the number of paragraphs. Please look at this. This starts with para number 50.29. It goes up to para number 50.41. Babre, my God, goes up to para number 50.40. So almost 11 points they discuss with respect to discount rate only. Now I want to take you to the factors that may consider, okay, with respect to, especially I want to take you to para number 50.32. I'm sorry, where am I? I'm here. 50. This is the, in developing a discount rate, valuer should consider. These are the points you should consider. And look at the word should. Look at the word must. There is a must means A and B has to be there. But should means, should, no, you go to an English teacher. She will say should, must, both are same, only go. But in international valuation standard, there is a difference. I'll take you to the glossary. This is your glossary. And in glossary, look at the term called should. Look at the word called must. Must means unconditional responsibility. You should do. No other second thought. What is there in the standard, I must do. No other second thought. But should means, should also English teacher say, should do you do it? Should you do? What do you mean by that? Should indicate response that is presumptively mandatory. Presumptively. Valuer must come here. Should contains must. But I want your complete attention for this word. Okay. Unless the valuer demonstrate alternative action. Say, wife says on a Sunday, what is this? Sunday you are free. Go and go to market and bring bendi. Bindi masala I want to make. Go to market and bring bendi 2 kilos. Okay. I want to stuff the masala in that bendi and I want to make it a very nice bendi masala. So by that, the way she explains itself, your tongue will be watering. So you go to market, anyhow find a bendi and you go to, because it is a direction from your spouse. You have to do it unconditional responsibility. Okay. Now, same Sunday, mother, ma says, yes, go to market and bring bendi. So you take the bag and you go. But bendi is not there. So you try everywhere, bendi, baingan is there. So you buy baingan. Baingan is actually brinjal. And you go there and then you say, ma, instead of bendi, you do baingan today, you will manage. So that is should, alternative action. But now look at this paragraph, very interesting paragraph, 105, especially the paragraph number, I'm sorry, I was referring to that discount rate. Okay. So the discount rate, let me take you to the discount rate. So this is your discount rate. This is market approach. Now I'll come to the income approach, DCF. So this is explicit period, terminal value. Now discount rate. Now here I want to, valuer should consider. I'll come to should later. First we'll go to must. Okay, let us go to the market. First bring bendi, then we'll go to baingan. Document the method used for developing, not calculating discount rate. How did you calculate discount rate? RF plus beta, RM, no, that is not. Document for developing the discount rate and support its use. Amazing. This is standard. This is standard. Now, I'll also bring to your kind attention the paragraphs in the ICAI valuation standards, especially with respect to discount rate. I want to bring your kind attention to para number. So where they are very keen about the para number 72. Look at para 72. The valuer may consider the following factor while determining the discount rate. That's all. Valuer shall include where appropriate risk adjustments shall expect as compensation uncertainty. This we have discussed. So this para number 73 is risk adjustment given in para number 40.4 international valuation. So that is keen. But this is one paragraph which is there only in international valuation standard, not in ICA valuation standards. What is that para? Document the method used. It is not there. Provide evidence for the derivation of the discount rate, including the identification of the input, support for the derivation or source. My God, this is nuts. Super point. I'm telling you, this I wish all our members pay kind attention to this. Now I'll go to Bingan. This is Bendy. Now go to Bingan. In developing a discount rate, the valuer should consider, okay, the type of asset being. Now this is there even in our ICA valuation standard. Look at ICA valuation standard. The type of asset being valued, life of the asset, okay, geographical location, currency type. This is should. That is why the word may is there. May consider. That is the alternatives. So that is there here. The rate, implicit, comparable, geographic location. So this point is there in ICA valuation standards. But this 50.34 is not there. Very important. International valuation standard very clearly. So in all my valuation reports, I ensure I do these two. I refer as per the international valuation standard, para number 50.34 for developing a discount rate. These are the two things I have done and I have the information. And one or two I will just spread them. So document the method used. So I will say I have documented the method and I have the references for it. Now what are the references? Provide evidence for the derivation of discount rate. So FBIL is the best reference. There is no second opinion on FBIL for risk-free rate. For risk-free rate, the best reference rate is treasury bill. All these are available. Beta, how will you arrive at the beta? Market rate, or straight away you can go for RF minus RF. So RF you already have it in what is it? FBIL. RF minus RF, Damodaran site is there. Beta is also there in Damodaran site. Beta is also there in a lot of Indian sites also. I can give you at least 20 to 30 sites. So take that as a reference and then give. So this is most important. You can give at least one or two reference. So that is what will make the valuation report glittery. Okay, glittery. So very, very important paragraph. This is what I want to bring to your kind attention. And I want to bring to your kind attention one more paragraph, which is para number 35, 36 and 37. Okay. Now, why? Because not 37, 35 and 36, guys. Okay. Now, look at this 36, 35. Valuers must consider the purpose for which the forecast was prepared and whether the forecast assumptions are consistent with the basis being applied. If the forecast assumptions are not consistent with the basis, it could be necessary to adjust the forecast or discount rate. See, this word is very important. Now, what is this? And the word is called must consider. The forecast, what you have done, are consistent with the basis. Basis is what? You want a fair market value, you want fair value, you want liquidation value, you want, that is the basis. So you want fair value means you discount it and arrive at a fair value. Now, if the forecasts are not consistent with the basis, it could necessarily adjust either the forecast or the discount rate. Now, what do you mean by your discount rate contains the risk index, but your forecasted cash flow doesn't have the risk index. Now, as the period increases, risk increases, but the discount rate has been factored with the risk. but you don't have the cash flows factored with the risk. So if cash flows you have to factor with the risk, cash flows will go up. So higher the discounted, higher the cash flows. So this is what is must. So this is also I must pay. And valuer must consider the risk of achieving the forecast cash flow of the asset when developing the discount rate. Specifically, a valuer must evaluate whether the risk underlying the forecast cash flows are captured in the discount. What do you mean by that? Simple. You have, that means a 10 standard should be compared with 10 standard. I should not compare a 12 standard mark with the 10 standard guy, or a 12 standard guy you compare with 12 standard guy. Now, your discount rate is higher because risk is there. Your systematic risk and unsystematic risk both are there in discount rate, but your cash flows are without risk. That means you have your based on a past year trend you project it. That risk index you have not factored in the cash flow. So what they say, must consider the risk achieving the forecasted cash flow when you develop the discount rate, because discount rate is built up method. Or using the risk rate. You take from FBIL, you take from Damodaran side, you say Damodaran side I have used, you say that asset management company side I have used CRISIL data I have used, you have said the CARE data I have used, all these you take. Then you should also have your cash flows also elevated to that level. That is what must, these are all must, mandatory. Okay. So guys, I must take last one point, only one more point I will discuss. That is with respect to model. Okay, that is with respect to the model, the valuation model. So this is actually, this PowerPoint has both IVS as well as the international IC evaluation standards, both. I'll only take one more paragraph. That is the last para. That is with respect to the model. The model, I think I have given it to the before. Yes, this is the model as valuation model. Please look at this. The valuation models refer to, I think I have given the link here itself. This is the link. This is the link which I showed you where you have the ERP number. So evaluation model refers collectively to the quantitative methods, systems, techniques, and qualitative judgments used to estimate the document value. Okay. So quantitative method. So that model. Now, what is the model with, especially with respect to your discount rate? You arrived at one model. Then you had a model for arriving at your cash flows. Okay, and you have a basis for it. Okay, so all these we call it as collectively a model. Okay, so this, it is not for company A, whatever data you have, you don't copy that and then you don't calculate. You have one plain dabba, one plain year 1, 2, 3, 4 like that you have, and then you fill up that. You just like a chess box, you just fill up all these data and then you discount it. So that is called modeling. Okay, so look at this. So while creating a model, the valuer must keep appropriate records, understand the output, consider the risk associated, and higher the risk, you can tweak it. You can adjust the numbers. Allowed under the valuation standards, allowed, and you have to do it. That is why I said you cannot compare a 10 standard with 12 standard. You have to only compare 12 with 12. Okay. So regardless of the model, the valuer must ensure, Bendy, that the valuation complies with all the requirements contained with the IVS. So I must thank both the chairman, secretary, and Mr. Karan Kumar Uppalapati for this wonderful opportunity. So, but for you, I would not have gone into the significant aspects of the valuation, especially the must and shall part of it. Maybe I'm open for any questions which our members have. So maybe we'll request members I'll request secretary to kindly allow members to interact and also unmute and then share their thoughts.
Yes, sir. If anybody raises their hand, I'm ready to. Members, please ask any questions. If anyone raises their hands, we will allow them to speak.
So we have many members. I'll now request any few of them to share their thoughts. Maybe
I think one attendee.
I will request Mr. Krishna
I think one.
is there. Krishna
I think
Sanil
one member raises their hand, sir. One member raises their hand.
Mr. Anji Reddy is there. So we'll request Mr. Anji Reddy to unmute. You can permit Anji Reddy to kindly introduce himself and share his thoughts. We have Venkateswar Reddy Murram is there.
Santosh, can you please unmute them or allow them?
Santosh, can you please promote them as a panelist? Ravi, you are also co-host. You can also do.
That's what I'm just searching the option.
Promote as a panelist, right? It will be there.
No, I'm just trying. Anjali garu, please.
Yeah. Good evening, sir. Thank you for the wonderful session, first of all. My question is, I'm aspirant of valuation examination, to introduce myself. I wrote 2 times, but unfortunately couldn't cross the line. Hopefully this time. And my question for the session, recently we have got a client, and his query is he is raising a funds now from some investors, and they wanted the investor is not asking for a specifically for the valuation certificate, but the one who is raising the funds, they are in a confusion whether to take the valuation from a registered valuer or the anybody, or the valuation is not required at all. They're in that confusion. To in future, if there is a notice as per maybe income tax or anything. So just this confusion we have, could you please clarify it?
Okay, now this is what we call it as a transaction requirement or a transactional analysis. Now, generally, I'm an investor. I want to buy a company, so I may not know more about. There may be the people who are in the board, who are the promoters, who are already the existing investors. They may give a rosy picture. So that is why I want to engage an independent professional to arrive at enterprise value, a business valuation, to arrive at an enterprise value, and to arrive at the equity share price, so that that can be maybe an indicator. Okay, this is called an indication of a value. Maybe I can from there I can come down. I will not go beyond that value. I will say, no, your company valuation is this, and it has a lot of other issues, like for example, risk factors with respect to your the present system. So your valuation report will capture all those risk factors also. When you engage the valuer, you have to tell them, please not only do the valuation, please also give how far the numbers are, how far the number is corroborated. I will not say numbers are audited. The word is called corroborated. Okay. So that means, do you have a basis? To what extent that the numbers are relevant to the present numbers? So that is called as transactional analysis valuation engagement. So this transactional analysis valuation engagement, there is no statutory requirement, but that is a purpose of valuation, which even a standard recognizes, both the IC valuation standard as well as valuation standard, and that can be done by anybody, including a practicing chartered accountant and also a registered valuer. So anybody can.
Okay, thank you so much, sir.
So we have Mr. Sunny.
Yeah. Yes, sir. Good evening, sir, and good evening to the Hyderabad branch chairman, secretary, and other members. Sir, first of all, I would like to thank you for a very delightful session. So you like hearing to your sessions is always a delight. How many ever times one kind of participate in your session, we always want to come again and listen to it. Thank you very much. You have kind of covered in very detail that income approach and the valuation standards with respect to the things like the important critical things like how the way you kind of consider the assumptions on a discount rate. in a similar way that the assumptions have to be considered for your forecast. Those are the real critical and important things and practical aspects. Thank you so much, sir. I have a couple of questions. One is, we have been hearing about this draft valuer bill for some time. Draft valuer bill. Am I audible?
Yeah.
Okay. So just wanted to understand some insight, like is there any traction happening around that one, or are we going to see that in the near future?
Maybe if like Krishna Sannidhi and Anji Reddy and like our Ravi Shankar Reddy and Gopal Krishna Raju, we are all silently watching the regulators to bring out the valuer bill. By this time it would have come, but there are some very good brothers, valuer brothers, who are actually very keen to question the government why there is a need for a valuer bill. And that kind of questioning, and there are some legal cases also that has been raised with respect to the legality of bringing out a draft valuer bill, and also forming a committee under FTA for bringing out this draft valuer bill. So the government is presently having a reservation with respect to this. So let the law take its own course. So after that only it will come. But valuers bill is definitely a very important step towards bringing all the valuers under one umbrella, and there will be a separate regulator also for valuer bill. So we'll have like the Institute of Chartered Accountants of India, we'll have the Institute of Valuation Professionals of India, so IVPI. So something like that. We'll have a separate council, we'll have an independent body, and we will not be governed by IBBI, but we'll only be governed by this independent institute. So let us all wait for that nice time.
Okay.
Maybe it will come very soon.
Okay. The second question, sir. When it comes to the other legislations like income tax and other legislations where certain valuation is to be done by a registered valuer, so there also, is it the classification of valuers has to be maintained, like LNB valuers have to do for LNB, or and the plant and machinery is to be done by a plant and machinery valuer? Is that specific classification given by IBBI or Companies Act is being followed in all other legislations as well?
Good question. I don't know. Maybe I belong to an era where Wealth Tax Act 1957 was there in our syllabus.
Right.
Okay, so now the Wealth Tax Act is repealed.
Okay.
But that means Wealth Tax Act is nowhere applicable. Slowly, Wealth Tax Act provisions have been every year through the amendments of Income Tax Act, they have brought into Income Tax Act. So that is a different thing. But even today, Section 34AB of the Wealth Tax Act it has life. Okay. And there is a register of valuers maintained by the Chief Commissioner of Income Tax in every state.
Right.
For various categories, not only for land and building, for securities or financial assets, for plant and machinery, for jewelry, for antique. For antique also you have valuers. Okay. So we have 10 category of valuers. We only know 3 categories. Asset class, plant and machinery, land and building, SFA. But under Section 34AB of the Wealth Tax Act, even today 10 categories are there. Okay. My request to my fellow chartered accountants is, there is more number of LNB valuers, and second rank goes to the plant and machinery valuers, but hardly SFA valuers we get registered. We are the people who are very close to Income Tax Department, but we hardly get registered ourselves as a valuer with the Chief Commissioner of Income Tax. So why not our members take it as a drive to en masse register with the Chief Commissioner and increase the number? So we are not doing it, and they need people, especially for black money valuation, black money law. So in black money law, they have invested money in various companies. You mean to say only land and building valuer can do it? No. we need chartered accountants to do valuation, to unearth the black money. So Government of India, Income Tax Department, CBDT, they need the help of chartered accountants. So in various places, there is a requirement. So we need to actually explore each and every place. As of today, it is fragmented. Certain portion are consolidated. So it is not 100% consolidation has happened. So one portion is consolidated.
So even I am from the wealth tax era only, sir, like you.
Very good, very good. So I'm glad that Krishna Sannidhi, you have enrolled with wealth tax.
No. One thing more, sir, I wanted to check with you, like from this is a different dimension, not only from an ICA standpoint, the other class of assets which are coming like NFTs and all. So is there any kind of a plan or thinking around going around in the valuers forum and how those kind of things have to be valued?
Very good, very good. I wish Hyderabad branch and our institute, they come out with further CP programs on number one, what is virtual digital asset and especially NFTs, what are the various digital assets that is possible with respect to this, and what are all the business prospects available, and how do we value this, and how it is different from an intangible asset. People even today, they think virtual digital asset is an intangible asset. Intangible asset is a different category. Virtual digital asset is a different category. Both the intangible asset also we cannot see, and virtual digital also we cannot see. Like very similar to both are, can we say both are intangible assets? Now it is like very similar to religion. So we say Jesus Christ, we say Krishna. So both are not visible only, but both are God. So one is a different form of God. They follow a different path of life. They follow a different way of life. Another people, they follow a different way of life. Similarly, NFT is a virtual digital asset, and the valuation for that is different because fundamentally we need to understand what is the income potential for it. So maybe the first question what I will put is what is the approach you will apply for an NFT? Is it income approach, or is it cost approach, or is it market approach? So for that we need to know what it is. An income approach hardly, barely will apply for NFTs.
Yeah, agreed, sir.
It is only cost approach. Or market approach.
The cost approach, there is no kind of a repeatable thing is there. Cost approach also may not be a appropriate one. So market approach also the comparatives are not there.
No, Krishna Sannidhi and Gopal Krishna Raju, we have some idea about NFT, but Hyderabad branch management committee, my request is kindly arrange programs where these things are also enlightened to our members, so they will be aware that okay, we are discussing about a topic where now income approach will not be applicable to why. So nice, thank you very much.
Thank you, sir. Thank you.
We'll definitely arrange, sir.
Next question, please.
Ananta Padmanabha, sir. Ananta Padmanabha, sir.
So we have Mr. Venkateswar Reddy Muran. Very good evening.
Okay.
Hello. Hi, sir. Good evening, sir.
Very good evening.
Sir, recently I qualified that Vishwa course. Any new suggestions for our newly qualified persons or newly getting into this position?
Oh, you are recently qualified.
Yes.
Very good. Congratulations. So you are asking for suggestions?
Yeah, I'm trying to get into valuation profession. I'm fully into that one.
Please first get a license from IBPI. And
yeah, I have applied for that one.
Very
it is
good,
pending.
Good. So my advance wishes that you should get it soon and start exploring not only the traditional valuation, because traditional valuation work anyhow you will people will approach you as being a registered valuer for normal buyback purpose, but try to explore areas on intangible assets, option pricing, ESOP valuation, and these kind of and financial instruments, various financial instruments like ORPS, like your preference shares valuation, debenture valuation, and various financial instruments, and also derivative instruments. So that is, these are the areas where we need experts, we need professionals to come out and give their services. So it is not only restricted only to what we call it as the DCF method alone. These kind of other methods also are equally relevant.
Okay, sir. Thank you.
Ananta Padmanabhan sir.
Oh yeah.
Ananta Padmanabhan sir, please speak.
No, I think he's not here.
Not here. That's it.
But
Then
Sandeep,
Krishna.
Krishna.
yeah,
Sandeep.
Krishna is there.
Yeah, thank you, sir. First of all, I would like to really give my gratitude to Gopal Raju sir for an amazing session. I can say that I am attending your DISA fast track session also in the morning, and the way you teach, it's completely exam oriented, and we can understand now, that where we are lagging or what are the points, what are the key words which we need to keep in mind. So thank you so much, sir. It was really very nice to hear your speech on various methodologies of valuation. So my question is that recently one of my client had reached out to me. He's an early startup, like in a pre-revenue stage, and they are approaching investors for funding. Now they want to know what should be their exit strategy for investor, like what base they should take and what is the rates they can quote to the investor, that this can be the exit strategy for them. So if you can share some thoughts, I know that this might not be a very small answer, but if you can just throw some light on it.
Maybe I'll give a very brief. Number one is entry strategy is find the present value of the future cash flows. And on that, they may take 30%, 40, 50% stake, whatever it is.
Okay.
Then second one is you have to mandatorily give them an exit route, either at third year or fifth year. So you need to find the valuation of this company today in tomorrow's prices. So valuing a company today is one assignment. For that separate fees. Valuing the company tomorrow, we will give the valuation report today for a tomorrow's price. That is 3 years later, 5 years later, whatever it is. So that for that separate fees is there. At that time, your valuation will be more because today your turnover will be maybe you go by today's present value is different, and 3 years later's present values will be the 3 years later's future value will be different. So at that point of time, your price of per share will be at least 1.5x or 2x. So if at all, especially for a startup company, the thumb rule is 3 years means minimum 1.5x should be the return, or 4 years to 5 years means 2x should be the minimum return. So that means if he invests 10 crores, he need an exit of 15 crores, or 5 years means he need an exit of 20 crores. So if the valuation suffices that, if your valuation suffices that, then only they will sit for a discussion. So otherwise your valuation itself says the multiple is only 1.2x after 3 years, or after 5 years is only 1.4x or 1.5x. The investor will not even think for negotiating at all. So I've given you an indication. So how you need to plan, and maybe if your figures are the figures given by the entrepreneurs are not that conducive, you need to tell them that this is your valuation, and ensure that you get a fees for that, because they will be only interested to close the deal. They will not be interested in the valuation. They will say, I need to close the deal, for that I need a valuation, so please do that. So that is not the case. Ask them to actually give them the facts. So how they will actually project, how they will actually lift their company if the funding is available. So that is most important aspect, especially these three factors you have to give: present valuation, future valuation, and the multiple what exit you will actually give to them.
Okay, got it. Thank you so much, sir. Sir, on this only one more question, like, is it required that in the early pre-revenue stage, they should go with a valuation report, or they can go with a financial modeling as well?
No, both are same only. If they do a financial modeling, that is only an Excel calculation.
Yeah.
But if it's a valuation report, you arrive at a value, you give a basis, you give a premise, you give a purpose, you also give the assumptions, you also give the factors based on which you did the valuation. You also give a limitation, caveat, and disclaimer. You give a lot of background. You say on what basis you arrived at the discount rate. You will say on what basis you did the forecast cash flow. All this you will give. So modeling only will give you a calculation. Then they will only be a calculator. Valuer is not a calculator. Valuer is value.
Okay, got it, sir. Thank you so much.
Sandeep Reddy, you may ask your question.
Yes, sir. Thank you for giving me this opportunity. I would like to thank the Hyderabad branch committee for arranging such a nice meeting. I have many doubts regarding the startup valuation. Thank you so much, Gopalakrishna sir, for giving us valuable insights. Sir, I have a question. Now we have few startups which are less than 1 year. For my companies, all the seed funding is done by our MD. Now he wants to go for further funding in the market. So he is asking us to value our companies. So in order to value our company, so even the revenue is not generated. We are in pre-revenue stage, at the inception stage itself. So how to value those companies? So how to forecast the revenues, whether it is for 5 years or for 10 years? How to determine?
Well, we have a method called Berku's method, where in the Berku's method, if you are at pre-revenue stage or before you go for marketing of the product, you are only at the maybe the concept stage, or you have a prototype stage, or you have invested with respect to manufacturing facilities, and after that you have the you have the various logistics and the marketing thing also you have done. So once you have all these flow, then the valuation will be higher. Now, if you are at the initial stage of maybe only the concept stage or only prototype stage, or maybe only with respect to you need more investments to actually buy the land, building, and then machinery, and then do the other setup and all, then the valuation will be very, very less. So that means your potential will be there, but your potential converting into money, there will be a lot of discount factor, because the benefit of the entire chain, what you have built up, if you have built it, the valuation potential will be more for you. Now, when the investor will bring the money, and because of that you built the 70% of the empire, the valuation, he will take more stakes. So the question is, what is the percentage of stakes you want? What is the percentage of stakes you will dilute? So from there, and what is the stage as of today? You have to tell them very clearly, you need to still go further, then only you can reach the destination. So you are, maybe they are more optimistic or more, what do you call it as, their expectation is very high. So either they need to wait for till they mature to bring an investor, or they should have that liberty, they should have that big heart to give the stakes maximum what demanded by the investor.
Okay, sir. Thank you so much.
So thank you very much. And
Sir, Ananta Padmarao, last question. Ananta Padmarao, sir.
He's not promoted as panelist.
No, he came actually. He came back.
Santosh, please promote him as a panelist.
Okay.
Anand sir, you want to talk?
Okay.
I think Ravi can proceed.
Okay. Okay. Sir, with this, we formally conclude the session, and already all our promoted panelists told vote of thanks. Nothing left to me, but from branch side, from on behalf of Hyderabad branch of SIRC FICA and on my personal behalf, my sincere thanks to you for giving an excellent presentation. Though I have listened this 3 times. Any doubts on valuation or whatever, I used to go to your 3S Pro blogspot.in. So it is an encyclopedia for any type of topic, whether it is valuation or DISA or in the independent director, whatever. So my sincere thanks for coming, sparing your valuable time and giving us this opportunity to serve our members. We, as you advised, we will take your help in conducting those new topics, digital currency, what you have mentioned. We will definitely take your help, sir. Now I request Deepak Ladda, sir, Chairman of the Hyderabad branch, to give closing remarks, and then the branch will share the movement to virtual.
Thank you, Ravi sir, and thank you, Gopal Krishna Raju sir, for an excellent presentation on the valuation topic. I am sure there are numerous professionals who have become valuation professional by attending your fast track valuation and the DISA classes and the IBP classes for information professional. We are very thankful on behalf of the Managing Committee of Hyderabad branch for addressing today to the Hyderabad branch members, and not only Hyderabad branch members, across other parts of the country also. And we look forward for your continuous cooperation. I'm sure you will never say no. Whenever there is a iota of time also, you will definitely allow us. And sir is very approachable, friends, for any topic, not only to the branch managing committee, but also to the members who approaches him. And he is very active in the social media. And sir has helped lot many professionals to get the additional qualification, as he is already multi-talented, gifted with multiple talent. You take any subject, I think the 8 subjects of the CA final, he can teach, he can write, and he can pass n number of times. This is the talent sir as God has gifted him, and he's been excelling in his profession. And we pray God that he continues to prosper and deliver the fruit to the profession. Although he is triple qualified, but his loyalty to the ICAI and Nanometer is first priority, I'm sure, sir, and it will be available for all of us, to all the chartered accountants for the generations to come, for the decades to come. Thank you, Gopal Krishna sir. Over to Secretary.
Santosh, can you share the virtual memento? Once again, our sincere thanks, sir. Please accept our virtual memento, virtual certificate of. Sir, having knowledge is different thing, but sharing the knowledge to all co-professionals and making them enriched with the same level of knowledge which he is having is enormous. And I really admire you, sir, for that. And not only a subject professional, he is a gentleman to the core, because I experienced him when I was working in Chennai office. He was SIRC member. He was such a nice gentleman and very member friendly and employee friendly. Thanks to you, sir. Once again, my sincere thanks to Hyderabad branch chairman and all the attendees who attended this program, and finally to Gopal Krishna sir. With this, we wind up this program.